Today is February 18th. This is Wall Street Beats. I have Robert Marson, Charlie Peabody, and I'm David Maris. Today we're going to talk about a lot of different things, including banks, a retailer, a whole bunch of biotech stuff. But why don't we kick it off, Charlie, with you? Charlie, maybe we can talk a little bit about what you're seeing at the bank conference and anything else about the names in particular, like Goldman and Citi. What should we be thinking about that here?
Okay. Last week we had a banking conference. We got some updates on how the first quarter was unraveling. And it's clear that we've started off on a very slow note in terms of bank fundamentals. Loan growth has been very sluggish, almost non-existent. Net interest income, or what we call top line revenues, is probably going to decline quarter over quarter at a low single digit rate. And investment banking, primarily in mergers and acquisition and M&A, has been off to a slow start. If things don't pick up by March, we're going to get some estimate cuts among some of the banks. I don't think it'll be drastic, pennies here and pennies there, but we'll get estimate cuts. So there is an underlying sluggishness. But that said, the stocks continue to do very well. But we're getting more and more of a stratification amongst the stocks. And in general, I would say that the money center banks and the capital markets banks are way outperforming the regional banks. The regional banks are much more dependent upon interest rate risk. They have less benefit from deregulation that we think is forthcoming. They have less excess capital to spend on share buybacks. And they're probably going to be the regional banks are probably going to be part of some sort of bank M&A activity. So some investors are a little bit concerned about what sort of dilution they may be. In general, I get the sense that investors are continuing to shun the regional banks, which have significantly underperformed the money centers and the capital markets. There are four names that I wanted to highlight in terms of things that were said last week that give them some unique stories that are allowing them to outperform. So let's start with Citi, because Citi is up 20% quarter to date. It's up 4% in the month of February. And there were two things that came out last week. One was the filing of their financials for Banamex, which is the operation down in Mexico that they want to IPO at the end of this year. And those filings led us to believe that we could get an IPO value of around $10 billion. And prior to these filings, people were talking 6 to 8 billion. So there's some upside there. And if I'm right in the upside valuation that IPO is going to get, we could get a $10 billion buyback next year in 26 when this IPO is completed. And that would represent about 6% of the shares outstanding. So that was a positive development behind the stock's move last week. And then secondly, Andy Sieg, who was the architect of Merrill Lynch's Thundering Herd back in the 1990s, joined Citi about 16 months ago to turn around their wealth management operation. And he laid out a path that can get their ROTCE from 10% in the fourth quarter to 15 to 20% by 2026. If he's successful in executing that, and I think he will be, that could add about $1.5 billion to $2 billion of earnings, or 75 cents to $1 a share on a 6+ earnings base. So two positive developments there. In terms of Wells Fargo, they had 4 consent orders that have been removed in the last month. We had laid out a path for the asset cap to be removed if certain consent orders were deleted. That's happened. So we're now pretty confident that the asset cap that has delayed Wells Fargo's balance sheet from growing is going to be removed anytime in the near future. So the stock probably is going to continue to trade up into that removal of that asset cap. But my guess is it's going to be a sell on the news. The one thing to think about as the asset cap is removed is that Wells Fargo goes from using that excess capital to buy back stock, which has immediate positive impact on earnings per share, to supporting balance sheet growth, particularly in the capital markets and in their credit card operations. And those buildups of those operations and the growth of those operations have a delayed positive impact on fundamentals. It's something probably you should pay up for because it's a business building exercise. But there may be a transition period where Wells Fargo's earnings have a lull as they move from buying back stock to supporting the growth of businesses. On the last thing I would just mention about Wells Fargo, literally at the very end of their presentation at this bank conference, unprompted by the moderator, the CFO came out and said, "Oh, by the way, I think your earnings models on expenses are too low. You're not taking into account the seasonal expenses that we usually have in the first quarter of $650 to $700 million. And the way he put it was he wanted you to lower their estimates by raising expenses. So if we don't get a pickup in capital markets and a pickup in loan growth, you're going to get some estimate cuts in March at Wells Fargo. So I just wanted to mention that caveat. The third name I just want to mention is JP Morgan. This is a company that continues to execute at a level that no one else is doing. This is by far the best management team, the best balance sheet, the best franchise. And while I mentioned that investment banking had started off on a weak note, they talked about and by the way, just so you know, the expectations for investment banking was for it to be up at a mid-single digit rate year over year. JP Morgan talked about their investment banking being up double digits. So they're at a much better level than anybody else. Their trading was also going to be double digits, very robust trading. So their capital markets activities is, again, separating the strength in their capital markets is separating them from the pack when the rest of everybody else talked about a sluggish start to the year. One of the things that JP Morgan did say, and is a little concerning, is that they're going to start cutting headcount, and they're going to do it in waves over the course of this year. And they said the focus is going to shift from positive operating leverage, which means revenues are growing faster than expenses, to unit productivity volume or unit volume productivity enhancements. What I mean by that is they're going to try and do more, in other words, higher volumes with fewer people. And so they're trying to increase the productivity of their employees. And that's very good about planning for the long term. And so I don't think this is a negative, but it does start to signal that they're worried about revenue growth in 26. And I think that's an important thing for longer term investors to think about. And it's interesting in that vein, Warren Buffett has been selling down his bank stakes. We got over the weekend that Berkshire sold the substantial amounts of their Bank America, of their Capital One, COF, and Citigroup. Buffett, who doesn't try and time markets, is also saying he's worried about the sustainability of bank profitability in over a multi-year period. And then the last name I just want to mention very quickly is Goldman Sachs. They also acknowledged that January had started off on a slow note in terms of capital markets, particularly in M&A. But what they emphasize is the long-term value of their franchise and their ability to grow in two areas, particularly capital markets and then financing their customers. And they've had an unbelievable financing of their customers, which they claim is a durable source of revenues going forward. I question that. I don't believe that. I think it's going to prove to be as cyclical as their trading businesses are. And I think they're taking on much greater credit risk in financing these counterparties, whether they're private equity or hedge funds or private credit. If we were ever to have a downturn in the markets, Goldman would be the first name I would sell. So let me stop there, David, and hand it over to you.
It's really, I really appreciate it. I will just say to anyone who's working at a bank who's watching this now, and if someone is telling you that you're safe in the wave of layoffs, I'm just telling you now that they always save the best and the highest paid to the end of the year. And then they'll let you go in December and they'll say, hey, I know you worked the whole year. You want a piece of your bonus? Yeah, you can have a piece of your bonus if you sign a non-disparagement or if you sign away this and that. You want your deferred? Guess what? I just tell you, everyone who's listening who works at a bank, get that resume dusted off now, whether you're being told you're going to be in the first wave or the last wave. Unless your last name is Diamond, don't believe them. I do want to say that we have Robert Morrison, and we're going to come back, Charlie, because I have a couple questions for you about tariffs, banks in Europe or banks in Canada, what Wells Fargo might do. And I know Robert wants to talk about two names, one that he's buying more of, one that he's maybe selling or he's short. But I do want to say to all the listeners, we're going to go to behind the paywall now. I'm going to talk about a whole bunch of biotech stocks and one non-biotech stock, IMS. But I'm going to talk about Ultragenics and SpringWorks and some others that I've been looking at. And so why don't we just jump behind the paywall now? If you're interested in hearing more about those or more about banks and possibly more about just trading in general, go to wallstreetbeats.com, sign up for the free trial if you're not already a subscriber, and we'll make sure that we get you all set up. Thanks. Now, I think we're going behind the paywall, but if it doesn't work, you're going to get this for free. Robert, why don't we talk a little bit about the two names that you wanted to talk about?
Absolutely. In the vein of reporting here what I trade personally in the last week, I did two trades, and one was an ad and one was a trim. I'll start with a trim. I recommended Chart Industries over the summer. It was about 110 to 120, and it got up to a little over 200 in 6 months. And so I decided to de-risk that trade with a 20% trim. It's a leading producer of natural gas equipment processing equipment, cryogenic equipment. And it's in front of a lot of secular waves of demand for that type of globally as the world needs more LNG and dry gas to feed power plants that are going to provide electrons for data centers. So it's a great concept. It's not a terribly expensive stock. It had gone from about 5.5 times EBITDA to 10 times EBITDA since I owned it. And that's pretty cheap compared to the equipment companies that provide electrical equipment. So they're in the 15 to 20 times EBITDA range right now. So while it doesn't compete directly with Eaton, they both sell equipment into the sort of the same markets. So it's the company. The reason for the trim is the stock is up 80% from my basis when I sold it. And the company has not really made any or beat any quarters in the last 2 or 3 quarters. And whenever it misses or guides lower, which they've done now for almost 2 years, the stock gets whacked. So they're due to report next week. And I just wanted to lower my position a little bit so I'd have some room to buy the stock back if it ended up going from 200 to 160 on a slight miss or a lower outlook going forward. So I still have 80% of my shares, but a trade is a trade, and I report them in real time. On the positive side,
Yeah, and that's isn't that always like a good idea when you get that in the beginning of the year, because companies sometimes will set their guidance so conservatively for the rest of the year that if you're up a lot, trimming a little bit into what could be just conservative guidance, it could be that they're still doing great and still going to beat for the rest of the year. Do you do that often, or do you just do it just because this one's been up so much?
no, I had 4 or 5 of them, David, in the last 6 months do that, and I trimmed. This would be one that I haven't thought about yet, but I did trim. So 4 of the 5 I did trim, and a couple of them, for the sixes I think about it, I did trim. But I've had a bunch of stocks that had big moves, a lot of air underneath the charts where they are. And if they just hint at a slowdown or conservatism, they've been getting clipped pretty hard. So when you have a double, you can give back half of that double on a bad earnings report. I had one stock that went down about 20% on a modest conservative guide, and another company, modest conservative guide, went down 35% in 2 days. So this is one that has been guiding conservatively, guiding down from very aggressive growth rates to still solid growth rates. They started the year at 15 to 20% sales growth, and for this year, they're down to 12. So 12, I think, is beatable. But if they guide to 10, or if they miss the number by 2 pennies because of a push out of a big delivery, this is a stock that went straight up, and it has that risk. So yes, that's actually a good idea. And I have done it in multiple stocks, taken partial profits at nearly 100% gains in 6 months.
Now, is there any truth to the rumor that you've been buying some new jeans at Abercrombie? Is that, or American Eagle? What's the
American Eagle. Yes, I'm a buyer of American Eagle stock. I actually did buy the jeans when I owned it a couple of years ago, and I liked them. I'm a fan of the product as well, and a customer. They're making a major effort to grow their customer base into the older age ranges from 15 to 25 or whatever they think of their base customer as. And I found the product to be very good and very reasonably priced, and I'm not ashamed to wear that brand. It's a
I'm
good
confused,
experience.
Robert. Are you in that age group?
I hang out with some in that. No, I don't. That's my kids
so
are. I
you've
have
been
kids.
buying this? You've been buying this stock recently, or is this just watching it? So
Yeah,
what
no,
prompted that?
I dip my toe in, and yeah, I dip my toe in it. and bought a very small starter position at 17, down from 26 when they cut last quarter's outlook. They cut this quarter in their outlook from the last earnings report. I think they report about 3 weeks from now for the fourth quarter for that. So the retailers all report in January, obviously, because the holiday selling season is so big. So the stock is acting terribly. It's at the 52-week low. It's crazy cheap, 4 times EBITDA. I think this year's estimate's $1.80. The next year's estimate's $2. There's no debt on the balance sheet. They do have capitalized leases, but to me, that's 20-year operating expense. So I don't consider that to be a debt covenant violation, risk bankruptcy kind of a liability. And they have 2 divisions. They have obviously the name brand, American Eagle, and then they have Aerie. And American Eagle's been flat for 10 years, and Aerie's grown to a $2 billion business from nothing, and it's only a $5.5 billion company. So Aerie's doing very well, growing double digits every year for 10 straight years. But they were calling it at one point a baby Lululemon. And I don't know if it's that, but it does its thing very well. And that's the source. That's the true growth company. And it's about half the profits now. So you have a growth company buried in there being dragged down by an anchor that's the name, that's the American Eagle brand. And they've tried to figure out how to improve that. And they've done some major renovations, including one in Philadelphia that I haven't gotten to yet, a store with very good results, 15 to 20% sales growth. So maybe they could figure out a way to make American Eagle grow again at mid-single digits. And if Aerie keeps growing at 10 to 15%, the growth rate could actually accelerate. They are under earning on operating margins. They're doing 8 and change percent. Their goal is 10% in the next couple of years. So they don't think they're over earning. You don't have any risk of this $2 number really being $1 in normalized earnings. Abercrombie did that. They went from 5% to 15% operating margins in the last 2 years, and they haven't yet committed to what's sustainable when their target was only 10. So these guys are targeting 10. If they get to 10, they'll make over $2 and they'll have leverage. So they'll be growing earnings faster than sales. But here's the real reason I bought more today. All that mumbo jumbo is great. Okay. You don't have to even think about all that. All I could say is I looked at the chart. Every freaking year for 20 years, the stock has traded north of 14.5. We've had a lot of shit happen in the last 20 years, right? There's been the COVID crash, the 18 thing. There's been a lot of up and down markets. This stock has, whether it was the high for the year or the low for the year, they've never not traded above 14 for 20 consecutive years. So if you buy the stock at 14, the bottom might be 12, bottom might be 10. It's a phenomenal long-term bottom at 10 to 12 if you look at a 25-year chart. But the highs are in the high teens to high 20s when people get excited about this. So if you buy this stock at 14 in the next 12 months, no matter what, it should hit 14 again. If it could go to 20 tomorrow and can go to 12 tomorrow. But you can count on it. If the pattern of it always hitting 14 for some reason continues, the stock, you should not lose money. And it's just a matter of how much money we make if your cost basis is 14.
Yeah, that's and pretty also, simple. If I'm reading it correctly, they pay a dividend, right? It's 3.5%, right. A little over 3%.
They pay a reasonable dividend, correct.
And if they don't have a lot of debt or they don't have any material debt that's like looming over them, like an existential risk, if they're profitable. And so it sounds like all these retail investors, all they care about is growth. So you get a ding because they're not showing amazing growth, but you get a company that could buy back stock, could be doing a special dividend, could be doing a lot of different things while it gets its...
It could be greed one day from a activist to do that stuff, to force that stuff. We could wake up on a Monday and it's being bought by an LBO firm, because there are LBO firms that buy cash flowing, no growth retailers that they try to fix. They think they're smarter. This management really thinks it's the world class. They say at an analyst meeting, they say world class management. I would take the CL off a class and call it a world ass management because they have delivered. The stock's the same price it was 25 years ago.
Yeah, I'm looking at a 5-year chart.
Market in the history of mankind. Yeah, they've missed the biggest bull market in the history of mankind, and they still call themselves world class.
It depends on world class at what. But again, I look at the 5-year chart and it's the same price, but I like that the fundamentals on it. So I'll take a closer look at it, but you're ahead of me. So no matter what, if it goes up, you're going to make more. So I'm jealous now.
Again, they need a growth angle. Something needs to pop in their business. And right now we don't see it, but if it happens and it starts to grow 7-10% on the top line with some kind of product cycle, it would be very positive for the stock. The stock could easily double if that were to happen.
Yeah. All right, cool. I want to talk a little bit about some biotech names, then I want to go back to Charlie with some things. First, I want to start with dumb upgrade or downgrade of the day. And I'm not making a call on Merck. I own a little bit of Merck. I've owned it for 20 years, so it's not a call on Merck, but Deutsche Bank downgraded it from a buy to a hold today with a price target of 105. The current stock price is $83. So if you're going to say it's a hold and you think that it's a 25% upside, 20 something percent upside, I'd like to see what your buys are, because that must be pretty compelling. So 26% upside and it's a hold. Now, and it's a downgrade from that. So the math doesn't fit with me. Now, his previous target as he downgraded was 128. So if you think of the valuation change that you have to have for a large cap stock to cut it by whatever that is, 25% or so, you have to have a major rethinking. So not a surprise from the sell side. Having, Charlie and I were both on the sell side, so we can say this. That's just stupid, in my opinion. Don't sue me, Deutsche Bank, but I think it's stupid. Now, I'm not going to talk about Keytruda and all the other things that can go wrong with Merck. I'm well aware of that. I am holding it. I don't think pharma's in a great spot right now with the administration, all the rest. Just putting that aside. So onto Ultragenyx, RARE is their symbol. The FDA just accepted their biologics license for rare disease. It has a priority review, which is always a good sign. And the PDUFA date's August 18th. There's no advisory committee meeting planned, which is usually also a very good sign. Usually means the FDA is confident in the data. They could always call an advisory meeting. Who knows? Maybe all the people who call the advisory meetings have been fired this last week. But the clinical trial results are encouraging. I own Ultragenyx. I think that it's one that I can stick with for a few years because they have a number of pipeline things. It has had a decent little run and is part of my biotech basket that I'll talk about a little bit. Talk about David Einhorn and we talked earlier about conservative guidance. Einhorn added to Teva, which is great. I own Teva. If you look at the chart for Teva, it looks horrible. It looks like a step down. It actually looks great, cover up the last month. And this is one that I recommended a year ago and did really well. And I stuck with it on this downturn, but they gave conservative guidance at the start of the year. And actually, at the very start of the year, they were at the JP Morgan conference and gave very encouraging, not guidance, but hey, the business trends look great. We're doing great. What's our turnaround? And then when they gave their earnings number, they gave guidance that was a little bit conservative. It was exactly in line with what I thought, but they're at 235 to 265. I apply a simple 10 times multiple for a generic company. With that, I get significant upside. So I'm stuck with it. I'm glad that David Einhorn is as well. He's a decent value investor. He's had some ups and downs too, like all of us, but I still think that this is a really good name. Also worth noting, Hims and Hers downgraded at Morgan Stanley today. The stock is essentially shrugging it off. You might look at it and say, oh, it's down 3 or 4%. That's not shrugging it off. If you bought it yesterday, you're not that happy with it. But for a stock that's come so far to have a downgrade from a major firm that had been supporting it to only be down 4% or so, it's pretty interesting. It tells me a lot about who's owning the stock, who's buying the stock. Again, I still own it. I had trimmed a little bit with Robert Morrison's approach of when you double your stock price in a very short period of time, you should take some off the table, even if you love and I think it's going to be an amazing quarter. I think the guidance is going to be great. All of that's true. But guess what? They could do all those things. And those aren't easy things to do. They could do all those things and the stock could still be down if people are waiting for that to sell. I'm okay with just taking some off the table and letting the rest ride. And then lastly, on Solid Bioscience, SL, I own some as part of this biotech basket that I put in place at the start of the year. They just priced a $200 million offering at $4 a share or 403 a share. So you might think big offering, stock must be down. Stock's actually up quite a bit. Cash gives them runway for clinical development. This is with any money losing $4 stock. There is a good rule of thumb that I had heard. I don't follow it all the time, but if you have a stock that's under $5 that's losing money, sell it because you could be at zero very fast. Now, raising money, this gives them the runway, so that will take that away. The people that bought into the offering, though, are like Adage Capital, Bain, Percept, really the blue chip of healthcare investors. Doesn't mean they can't be wrong also. They're spreading their risk over a lot of different things. I'm not trying to tell you like, oh, you should do it because Adage did it, or because I did it for that matter. But for me, taking away the financing risk for another year or two is great. And so I own it, and I think that it could have a pretty good run, especially as they click off some clinical milestones. So with that, I want to go back to Charlie on the banks. One thing that came up, Trump said the other day that if you look at Canada, there aren't large US banks with lots of branches in Canada. And he was implying that Canada's holding us back from being in Canada in a meaningful way. First, is that even true? Having worked for BMO in the past, I was a proud Canadian American working for a Canadian company at the time. I didn't notice it. I did going to Canada and seeing BMO offices everywhere. You don't really see them to US. Is the opposite true? Are they really holding us back? And is that something that, if you think of Wells Fargo now being unleashed, are they going to buy a regional bank? Are they going to buy an international bank? Will they buy an asset manager? What do you think?
Wells Fargo actually is in Canada in a lot of non-bank operations, but your comment about banking operations is true. The U.S. does not have large banking, particularly on the consumer side, operations in Canada. And it's largely because Canada is owned by the big five. There is much more significant concentration of share in Canada where the big five really run everything. We have, 5,000 banks here in the United States. So we actually have Canadian banks that have bought into the United States, like BMO and RBC, but the U.S. has not tried to set up consumer banking operations in Canada. They do have, obviously, corporate banking operations in Canada, but it would be very difficult just because of the concentration of market share by the big five in Canada. So I don't see that happening anytime soon. And technically, JP Morgan could buy a Canadian bank. I'm just not sure what would gain them.
Yeah, so I was wondering, though, the reason I mentioned Wells Fargo is that if you have this, Canadian banks, I think, by reputation at least, they're much more conservative. So I would imagine that their balance sheet is pretty conservative. And so you get that arbitrage of a high multiple company buying a low multiple company that's also really cash flow generative. You get a boost there, but maybe I'm overthinking that. So what do you think Wells Fargo does if they don't look internationally? What do you think? Do they buy an asset manager, or do they buy a regional bank, or what?
The two areas that they are definitely plowing capital into is growing their credit card operation. That's a 3-year effort now, or 3 years ago. And then more recently, they've been building out their investment banking and trading capabilities in the capital markets. They're punching way below their weight. When you think of them, they're in the same league as America or a city in terms of size, but way below them in terms of market share. I think they're 7 or 8. I'm not exactly sure on the capital markets in terms of market share. So they can significantly create organic growth in those two areas, cards and capital markets. The other area that you mentioned, David, which is actually appropriate, is wealth management. Everybody's trying to build up their wealth management operation right now because they see a secular growth there as you get this transformational wealth from one generation to the next taking place. And Wells Fargo lost a lot of market share in wealth management, lost a lot of financial advisors. They're rebuilding that effort. That's going to take time.
All right. So what else do you have? Anyone have anything else you want to talk about before we jump?
The one thing I do want to mention, and Jen, I don't know if you can put up that second chart showing private equity and private credit exposures, but last week, for the first time, banks had to file with the FDIC on their non-bank depository exposures. And there are 5 subcategories that banks are lending to that are non-bank entities. And the reason that the regulators are requiring disclosure of this data is because they're very concerned that this is going to be the epicenter of the next problem if we have a credit downturn. Because non-banks have taken huge share of credit over the last 5 and 10 years. Back in 2010, the lending by the banking system to non-banks was maybe 50 billion, and now it's 1.2 trillion. So it's on par with credit card exposures. It's on par with mortgages to commercial real estate exposures. So we've had phenomenal growth amongst these non-banks. And the regulators are obviously worried about counterparty exposure. And as I mentioned earlier, Goldman Sachs has had this phenomenal growth in their financing revenues in where they're supporting certain counterparties. And I think a lot of these counterparties are funds, private equity, and private credit. So what I did here on this chart is put together the disclosures that are, as I said, brand new. No one has seen these disclosures before, to give you a sense of who's the biggest lenders to private equity and private credit. I just focused on those 2 categories. As I said, there are 5 subcategories, but I just focused on those 2 categories because I think those are the biggest issues. And just a couple of observations. In terms of total dollar exposure, Wells Fargo is the biggest lender to private equity and private credit with $91 billion of total exposure. In terms of exposure, private credit and private equity and private credit exposure as a percentage of loan, Goldman Sachs is the biggest at 20% of their total loans in this category, which is why I think they're big lenders to, and financing, a lot of their financing revenues come from this area. And then in terms of equity, these private equity and private credit exposures as a percentage of your tangible common equity, Wells Fargo and Citizens Financial are the biggest exposures. I don't think anyone considers these exposures to be a problem today, so I don't think there'll be any concern. But it is something that I think the industry is going to monitor now that you're starting to get these disclosures.
All right. Robert, anything else other than some sunscreen?
I'm all good. I'm ready to hit the pool.
All righty. Well,
don't forget to put on the floaties.
The floaties. The only other thing that I have is I'm going to be taking a look this week into Centene. That's another one that David Einhorn recently bought. It's been off my radar for so long. It's been not such a great stock, but I'll take a look. Maybe there's some treasure in the trash.
Hey, David, let me ask you something, because you mentioned David Einhorn several times, and I admire his intelligence and investment style. But as he is a value player, I'm a value player as well. I'm always a year too early. And I'm guessing you're a value player. But hasn't he said that value investing is dead or broken?
Yeah, so he's had a rough go over the last several years, like a bunch of years, and he admits it. It's not stylistically his time, and he thinks that some people may be crazy on how they're investing and the market and the rest. I think he's super, super smart. I think his timing of buys and sells could always improve. I think he would say that about me as well. I have a hilarious story about a book that he wrote and how I'll tell it some other time, but it's a really funny story. So I think he's honest. I think he's intelligent. I think that he identifies things early. How he times buys and sells may not be the best, but that's why watching what he does to see, okay, is this a good idea? Isn't it? He hasn't been particularly good in healthcare during my teen year career, 20 some odd year career. He never had a healthcare person that I was like, okay, that person is like the Millennium person or the Balyasny person or the Fidelity person. He's always had more of an in-house, say always, when I was working on that side of the business, he had a lot of jack of all trades would be too derogatory because they weren't just like jack of all trades. They're very good, but they would look at a lot of different industries. Healthcare, I think you need, and he didn't really have that. That said, Centene is actually, I'm like a growth and value investor. I try to create a mosaic where I have some in one category, some in another. And so when he's looking at Centene, I pulled it up. I was like, oh, what a junky looking stock. Now let's look at it. And that's actually, it makes it interesting, right? When you throw something away and you never look at it again. But
My question was really a broader question, and that is there's this debate about whether value investing is working right now or growth momentum investing. And Jen, I don't know if you can put up that very first chart that I gave you that shows the heat map or price performance of bank stocks, because I think we're moving into a year where stock picking is going to be much more important than getting the group right or a style right. And I say that because I don't know if this can be seen, but that very right-hand column shows the first quarter to date. And we're getting a huge stratification amongst bank stocks, which are value investing stocks, and they've generally done well. They've generally beaten the S&P. But you probably can't see this, but Citigroup, for example, is up 20%, whereas US Bank Corp, which is the red number down there, is down 0.2%. That's a huge disparity in my group. And you're seeing that more and more where a JP Morgan is up, but a PNC is down. And so it's becoming more of a stock picker's market. And I think that's where a person like David Einhorn excels. But it
Yeah, and I
also,
think, by the way, if you look at what you're saying is absolutely right. If you look at healthcare so far year to date, it has been dead for the last couple of years, and it's actually outperforming now. Now, will that last? It could be because Trump hasn't said anything really bad about healthcare yet, but we'll see if they're doing the cuts and all the rest at different NIH and FDA. But right now, no one's really worried. I shouldn't say no one's worried about it. Lots of people are worried about it. Investors don't seem to think that it's going to have an impact on stocks yet. And so, yeah, I think that value it's on the verge of not being cool again, but actually it's hard, right? When you have these giant tech companies that are starting to turn over a little bit, that money has to go somewhere. And I'm glad to see that it's not going to other high-flying, money-losing companies rather than it's looking for cash flow.
Yeah. Some people are talking about a melt up in the market. And I don't know. I don't particularly have an opinion if we're going to get that or not. But if we do have a melt up in the market, it's going to come from a broadening, I think, of the base of stocks. I think there's only like 50% of stocks right now are above their 50-day moving average. And so I think value stocks will play a big role in that melt up if it occurs. I, again, have no opinion.
I would suggest one other thing if you have time to watch. There was a presentation last night that Elon Musk did with the Twitter team or the X team talking about Grok 3 and the rollout of Grok 3. And even for someone who's not a tech investor, Grok is their AI. Grok is their AI thing. And you can find it. If you're on X, you'll see there's a menu selection for Grok. And you can also sign up for it as a paid account. Grok 3 is their newest one. So even if you're not a tech investor or deep into AI, if you watch this presentation, you'll see some charts that show how in just the last 6 months, they also talk about a server farm that they put together. Absolutely amazing. And you understand the rate of change that's going on with AI by just a few of these charts. It's a little long. It's about an hour-long presentation. But if you jump about halfway through, save yourself some time. But it's really impressive of what they've put together in such a short period of time. And I'm not trying to talk up Elon Musk. I don't think he needs that. But for tech investors and non-tech investors, if you're trying to understand what is AI, how fast is it changing, you can see that they went from greenfield to topping DeepSeek and topping ChatGPT and computation power in a very short period of time. It's fascinating. With that boring end to an advertisement for watching the webinar on AI, we will close it out there. Everyone have a great Tuesday, if that's possible. And if it's not, make it the best Tuesday you can. Thanks again. See you.